And I'd like to introduce Ed Gresko from CSEA.
Good evening and welcome, everyone. Welcome. I'm Ed Gresko, Director of CSEA Child Care Programs. For those of you that don't know me, my wife and I operated Closest Home Family Daycare for over 20 years here in Albany, New York. And now, like I just mentioned a moment before, I am the Director of the Child Care Programs. This evening's presentation by Tom Copeland, Tax Changes 2020, is brought to you by the New York Partners, comprised of the Early Care and Learning Council, representing 35 child care councils, WEDCO, a community advocacy organization in the Bronx, the UFT, the United Federation of Teachers, the union represented family child care in New York City, and of course, CSEA Voice Local 100A, which represents the providers in upstate New York and Long Island. Once again, I have the distinct pleasure of introducing Tom Copeland, the nationally recognized expert on the business of child care. Tom's knowledge and expertise has been valued by family child care providers for decades. Alas, Tom is retiring soon. We will miss you, Tom. In the words of the immortal Janis Joplin, you've got to get it while you can. So let's have at it, Tom.
Okay. Thank you, Ed. Thank you, Jessica. So let me get this organized here. Okay, so now I'm set. Great. So welcome, everybody. I'm coming to you from my home office, St. Paul, Minnesota. A little bit of snow on the ground, a lot more coming tomorrow. So we're going to be talking about tax changes that affect family child care providers in 2021. We're going to be looking at what's taxable income, how to treat the stabilization grants, understand what you can deduct, how to calculate your time and space percentage, particularly if you are closed for any period of time this year. Then we'll look at deducting vehicle and food expenses, excuse me, deciding when to claim Social Security benefits, and take a brief look at the SBA loan programs. I'm an attorney, a trainer, an author, an advocate for the business side of family child care. If you have questions after tonight about what I'm talking about, or questions about other aspects of your business, feel free to give me a call or send me an email. I don't charge anything for answering questions. Your questions might be answered on my website, tomcopelandblog.com, where I posted hundreds of articles on all aspects of the business side of family child care, including a recent post this week of a video describing how to deal with the stabilization grants, the tax implications of the stabilization grants in detail. I'm also on Facebook. Every time I post an article on my website, it will appear on my Facebook page, and you can ask me questions there. For purposes of tonight, post your questions under the Q&A. I've sent on a copy of the PowerPoint, so in addition to a recording of this, you will also be able to get access to these PowerPoint slides. I've written a book, Family Child Care Record Keeping Guide, that lists over 1,000 deductions and explains how to keep records throughout the year. I've done a DVD on record keeping that goes into this topic in great detail. Both of these resources are available through Red Leaf Press. I'm not your tax preparer. I'm not your attorney. If you need professional assistance, you need to seek it out. So, as we all know, the last year and a half have been extremely stressful. Some providers have closed temporarily, some permanently. Many providers are hurting financially. What are the tax consequences of the changes that have resulted because of the pandemic? And how can we cope with these changes? What are some of the differences this year? State grants, are those taxable income? If you're working more hours because of COVID, how does that affect your taxes? What COVID-related expenses can you deduct? What are the new rules for 2021 regarding the standard mileage rate and the standard meal allowance rate? And how do you get your SBA loan forgiven? Record-keeping taxes are about tracking income and then tracking expenses. So let's first look at income. Money you got from parents, the subsidy program, the food program, you all know that's taxable income. But grants, state grants, federal grants are also taxable income. Now, the stimulus checks we received many months ago, excuse me, at the beginning of the year are not taxable income. If you got money through the Paycheck Protection Program or the Economic Injury Disaster Loan Program, both of those programs are not taxable income. You don't have to report that on your taxes. Money you get from parents or the subsidy program is still taxable income, even if you got this money while you were closed. So you might have closed for a month, but some or all of the parents might have paid you all of it or part of it. If you still got paid for caring for subsidy children, even while you were closed, still taxable income. If you were open, but parents, excuse me, you're open, but parents did not want to bring their children to your care because they're afraid of COVID, but they still paid you. That's still taxable income. In other words, whether you're open or closed, if you were receiving money, even if you weren't providing care, still taxable income. If you were charging a holding fee to hold a spot for a new family, to hold a spot for a parent who wanted to bring their child back to your program after the pandemic subsides, any money you get through a holding fee is still taxable income. Now, money you don't collect from parents is not a deduction. So, parent left owing you $400. You can't turn around and put $400 on your tax return as a deduction. If you gave a discount to a parent, you used some of the subsidy money, some of the stabilization grant money to subsidize the parent. So you said, parent, you don't have to pay me $500. Okay, great, good thing to do, but you can't deduct it. You can't claim it as an expense. If you call it a subsidy, if you call it a discount, if you call it a scholarship, however you give parents a break, cannot be turned around and claimed as a deduction. Grants. Any New York grants that you received earlier this year are still taxable income. Monthly stipends, whatever it is, when you got money because of your business, that's income to your business. Now, if you took some of these state grants and bought items for your business, then you could deduct them based on how they were used. Let's just say you got $1,000 grant and you turned around and bought a swing set that was used exclusively for your business. You would report 1,000 as income and 1,000 as a deduction. And you'd wipe out that income and would not owe any additional taxes. What instead, if you use the $1,000 for the swing set, but your own children also use the swing set? Because it's now business and personal use, you can't deduct the full 1,000. You can only deduct the business portion. And the business portion is what we're going to call a time and space percentage that I'll explain later. Let's say for this example, your time space percentage was 30%. So you could then deduct $300. The other $700 is taxable income. But you're not going to pay $700 in taxes. You're always going to have more money left over after you pay the taxes. You may owe a couple $100 in taxes on that $700. You'll always have more money left over. In other words, you're always better off getting a grant, even if your taxes are going to go up. So now let's say something more specifically about the stabilization grants. New York received a whole lot of money for stabilization grants, and you've probably already started receiving them. If you haven't applied yet for this, you definitely want to. It's money. Somebody's giving you money. You want to take it. The grants are taxable income. But no matter how much tax you're going to pay on it, you'll always have more money after the taxes. What can this money be used for? You can pay yourself or employees, rent, mortgage, utilities, facility maintenance, COVID supplies, general operating expenses. That covers just about everything. Other goods and services, food, mental health support, professional development, a whole lot of things. Paying yourself. You can use part or all of this money to pay yourself. Now, this can be a confusing topic because providers are not used to thinking about paying yourself. What does this mean? You can pay yourself with the grant money. That's an appropriate use of the money. And once you've paid yourself, now you can use it for whatever you want. You can use it for personal things, retirement, vacation, create an emergency fund. You can't use the grant money directly for that. But once you say the money's for yourself, now you can. Or you could still use the money for major home improvements, other business expenses that aren't allowed by the grant. In other words, you can't use the grant money to build a deck or to put in a patio or to remodel your bathroom. But you can use the money for that after you pay yourself first. So now the question is, how do you pay yourself? There are three ways. You could transfer money from the account where the money came in to any other account. It can be a personal account, a business account, a checking account, a savings account, it doesn't matter. You're just transferring it. And when you transfer it, make a note on your records, or if you can in the transfer system, just you need a note that says payroll for myself, stabilization grant. You're labeling this money to identify it as paying yourself. The second way is to write a check to yourself. Or, yeah, is just writing a check to yourself and put in the memo line, paying myself stabilization grant. Or thirdly, just leave the money in that account and write a note. Let's say every month you're getting some money. So when the money comes in, you just write a note that says, December 10th, $5,000 stabilization grant, paying myself. You are just telling the state that this money was paying yourself. You're just labeling that. And that's all you have to do. Once you paid yourself, you've done everything you need to do as far as the stabilization grant reporting goes. And now you can do whatever you want. And I highly recommend paying yourself with all of the money, because then you don't have to worry about whether or not what you're spending it on is approved by the state. Because once you pay yourself, it doesn't matter. When you're paying yourself, you're not reporting it as income again. You're reporting the money as income once you get it, but paying yourself is not like, you're paying an employee or you're working for somebody else. It's not income again. You're reporting the stabilization grant money in the year you receive it. So if you got a check in December this month, this is 2021 income. You get a check in January, it's 2022 income. Now, you may be getting a lot of income this year, and maybe you're not able to spend it all on items for your business because there's not that many more days left in the year. In that case, you would be showing higher income this year, not many deductions, and paying more in taxes. Then next year, when you have time to spend it on items for your business, you're able to claim all those deductions next year. Question: what if you're a partnership? Can both partners pay themselves? The way a partnership works is the stabilization grant money comes to the partnership, I presume. The partnership reports it as income. The profit from the partnership then gets divided between the partners. 50-50, 60-40. And that partnership income then flows down through each individual partner. And now, can the partners, so your question is, can the partners pay themselves? Yes. Once the partners get the money, they can then declare that that money is paying myself. Yes. Okay, question. How much in taxes are you going to owe on this money? You cannot use the grant money directly to pay taxes. You can pay yourself. Now that you've paid yourself, if you're not going to spend it on something for your business, you're going to owe taxes on it. How much in tax will depend on your personal situation. But roughly speaking, I would say somewhere between 20 and 30% federal Social Security, federal income tax, state New York income tax, maybe 20 to 30%. It can vary, but that's a safe amount to put aside to cover yourself for taxes. A few more words. Let's say you got $3,500. I know you're getting a lot more, but let's just use this number. If you spend it on items used exclusively for your business, you won't pay any more taxes, and you'll have nothing left over in your pocket. If you spend it on items that are used both by your business and by your family, you'll have to pay some taxes, but you will have some money left over. If you use this money, all of which to pay yourself, you'll owe about 30 to 40% in taxes, or about $1,000 to $1,400 in taxes, roughly. That means you'll have $2,000 to about $2,500 left over in your pocket. So to have the most money left over, pay yourself. All right. Let me catch up on questions. How do you determine how much to pay yourself? Is it based on your net income from 2019 or 2020? No. You can decide yourself how much you want to pay yourself. It has nothing to do with how much money you're making now or last year or the year before. Maybe you're making as much money now from parents than you ever have before. You can still take all this money and pay yourself. So it's all up to you about how much you want to pay yourself. If you pay yourself, you have to pay taxes on it. But if you use it for something that is allowed for the business, you don't have to pay the taxes. True. In other words, you take $1,000 and pay yourself. But then you take the $1,000 and now buy something exclusively for your business. You're not going to pay any taxes on it because you spent it all on your business. Whether you use the money directly for something for your business or indirectly after paying yourself, it's the same answer. If you use it for something exclusively for your business, you're not going to pay tax on that amount. Question, why can't you use the money to remodel a bathroom that is used for daycare? In the last webinar, I believe it was stated you could. Well, you can't use, in my opinion, you can't use the money to remodel a bathroom because it's probably could be considered a major improvement. Now, the language, I have to think back as to what the language is in New York, but the answer is going to be the same. If the state says, yes, you can use the money to remodel your bathroom, great. If you really can't use it to remodel your bathroom, pay yourself, and then you can use it to remodel your bathroom. So to me, rather than worrying about exactly what you can use it for or not, just pay yourself first. Then go ahead and use it for whatever you want for your business. When I pay myself using grant money, how should I address it if I'm using a check? You just write your name, Tom Copeland, and in the memo, you say stabilization grant paying myself. So you write the check to you, in your name. I'm remodeling my bathroom. it's 100% daycare space. I have a 2-family home and I live in one half. The daycare has its own space and is 100% daycare space. Can I write the entire remodeling off? This is a tricky question. So I'll answer it, but then if you want to follow up with me, and I can explain this in more detail. If the remodeling cost is less than $2,500, you can claim all of it in 1 year. If it costs more than $2,500 and you have at least 3 bathrooms, then you can deduct all of it in 1 year. If it costs more than $2,500 and you only have 2 bathrooms, then you'd have to treat it as a home improvement that you would have to depreciate over 39 years. However, there's an exception to this depending on the purchase price of your home. There's what's called the safe harbor for small taxpayers. So I don't want to go into that. It gets too complicated. So contact me later and I can tell you if you might qualify for that safe harbor rule. Question. When you mentioned reporting revenue based on when you get it, which is what I've said, you get money this year, report it this year. And this question that sounds like I'm talking about a cash basis taxpayer, that is true. This person then says, we are using an accrual basis method and plan to record the revenue when we spend it. You are right. If you are an accrual basis taxpayer, then yes, you can move the income to the year you spend it. That is true. Very few providers use accrual, but you can if that's what you are doing. All right. We received a $2,000 check from the Child Care Council, funded through ESL. Was this a grant? Yes. Does it have to be counted as income? Yes. Question, we are a C corporation. Can the stabilization grant be paid 100% to the owner, to one owner? Yes. If you're incorporated and you're an employee of the corporation, then you flow the stabilization grant through the corporation to the individual, subject to all the payroll taxes. It's like you're giving them a bonus. You must do all the payroll tax withholding to the person who's getting the money. All right. Question, how far back are you allowed to go back? I just started receiving payments in November, but am I allowed to apply it to rent I've paid all year? You can go back to January, and I'm trying to remember if it's January 1st or January 31st. You can go back to January for expenses like rent so far this year. Question, how do you determine if a purchase is just for your daycare or also for my family? For example, I bought a window shade to use during nap time. I only bought it for the daycare, but we open and close it when daycare is closed too. So if you're using, it doesn't matter why you're buying something. What matters when trying to determine how much you can deduct is how it's used. So you bought a window shade in a room. Are you in that room when kids are not there? If the answer is no, then the only time the window shade is being used is for business, and you can deduct 100% of it. If your family is using that room after the kids are gone and are using the shade after the kids are gone, That's personal use. And now you can only deduct part of the cost of the window shade. Question, is this stabilization grant from the Office of OCFS? Yes. The deadline to apply was November 30th. That's true. So earlier I said sign up. As I remember now, you're right. The deadline has passed. Question, what about using the grant money to repair a walkway and a driveway? Yes, a repair you can use the money for. Can I use it to paint the outside of the house? Yes, you must apply your time-space percentage for that. What if I was to remove trees from my property and expand my driveway so I can accommodate staff and parents? You can deduct this. Apply the time-to-space percentage. Would paying the mortgage and utilities for the home where the daycare is housed is considered using the grant for business, and therefore the money would not be taxed? If you're using the money for utilities, utilities are a business and personal expense. So you can only use the business portion of the utilities for the grant money, and the business portion of the mortgage for the grant. So you're not going to be able to, let's say your utilities are $1,000 a month, and your time space is 30%. That means you can use the grant money for $300 each month for the utilities. You can still deduct the $300 as a business expense. Can you use the money for a walkway to the entrance of the daycare? Yes. Question, if I pay myself, do I issue myself a W-2 form? No, no. As a self-employed person, that's what I'm talking about now. You do not use a W-2 because you're not an employee. That's why the term paying yourself can be confusing. Okay. Question, I only use the grant for payroll. At the end of this year, I will have leftover money. What should I do? If you need to buy something for your business before the end of the year to improve the quality of your care, go ahead and spend the money this year, and you'll be able to deduct it. If you don't need to buy anything, just keep hold of the money and buy something next year. You'll pay taxes on it this year. You'll deduct it next year. Will you get a grant, a tax form? Yes. The state will give you a form 1099 that will say how much you got, and the IRS will know how much you got. So they'll be looking for that on your tax return. Can I deduct this for an invisible fence to keep the dog away from the children? Yes. I had to put in a paved driveway. Can I use this in full? Well, no, because you're using the driveway for yourself as well, but you could deduct the time-space percentage of a paved driveway. Somebody says OCFS website didn't say pay yourself. It says personnel. It used the word personnel. So if you want to send me an email, I can show you where it says this, that means a family childcare provider can use this money for personnel for herself. And I can show you the official guidance if you want to send me an email. Can I remove a tree? Yes. I have a center So whatever is used strictly for the business, using all of the money, there won't be any taxes. That is true. Question, a dishwasher would be a time space percent item? Yes, because it's shared business and personal. Question, if I'm an owner of a C corporation, but receive 100% of the money, you're going to get a W-2 about that. Yes, because your corporation has to withhold payroll taxes. All right. If we just paid ourselves with the money, be taxed on it, and you'd have more money left over at the end of the year than spending it on something. That is true. Okay, do you need to submit a sheet to the state to prove where the money went? The state will not ask for records showing how you spent it. You won't have to submit receipts or anything like that. You should keep receipts and keep records indicating what you did with the money in case you ever get audited. But if you're paying yourself, the only record you need is that note that said you paid yourself. All right, I'm going to move on and talk about expenses. And then I'll come back and pick up some more questions later. If we were all in a room together, I'd say, how many people here love record keeping? Do you love record keeping? Very few people would raise their hand, one or two. You went into this field because you love children, not because you love record keeping. But keeping records, keeping good records, will mean a significant benefit to you. The better your records, the lower your taxes. There's only 3 ways you could make more money doing what you're doing. You could care for more children if you wanted to, if licensing allowed that, but that's not so easy. You could raise your rates, but that's not so easy. Or you could reduce your taxes. And I think reducing your taxes is the easiest way to make more money. How important is record keeping? For every $10 of an expense that you claim on your tax return, you'll save about $3 to $4 in taxes. You're reporting your income, you're subtracting your expenses, and what's left over is your profit. As a self-employed person, you'd be paying about 15% Social Security, Medicare tax on your profit, plus federal income tax, plus state income tax. Adding that together, most providers pay a tax somewhere between 30 and 40% on their profit. That's a lot. But the good news is that every expense will significantly reduce your taxes. So let's say you got home and you had spent $100 on something used exclusively for your business, some toys, some children's supplies. But you lost the receipt. Where's the receipt? Let's say you left it in your car. Is it worth your time to go open the car, look under the seat to find that $100 receipt? Yes, because it's going to save you $30 to $40 on your taxes. That receipt is worth $30 or $40 to you. You're going to earn more money per hour doing record keeping, then you're earning per hour caring for children. You need to save your records for at least 3 years. The IRS can audit you back 3 years. 2020, 2019, 2018. They cannot go back further than 3 years unless you didn't file a tax return, are cheating, or you're significantly under-reporting your income. You can amend your tax return back 3 years to fix mistakes. If you do that, you would use Form 1040X. Amending your return will not increase your chances of being audited. So don't hesitate to amend your tax return if you need to. All right, we've talked a little bit about this, but now let's talk more generally about what can you deduct. You can deduct any expense that is ordinary and necessary for your business. Ordinary and necessary means typical, helpful, appropriate, useful, common in your business. Your business is providing a home learning environment for children. Parents expect you to maintain your home as a home. Therefore, anything that helps to clean, repair, or maintain your home as a home is considered ordinary and necessary. Do parents drive by your house to see what it looks like before they're going to enroll their child? Yes. Are you required to provide a safe outdoor place for children to play? Yes. If you're doing childcare in your home, what expenses associated with the outside of your home would be considered ordinary and necessary? Lawnmower, gas for the lawnmower, repairing a lawnmower, paying somebody to mow your lawn, a snow shovel, a snow blower, paying somebody to plow your driveway, planting a tree, taking down a tree, sod, fertilizer, shrubs, flowers, stepping stones to get to the front door, the welcome mat, the doorbell, the Christmas wreath on the door, the street sign, repairing your chimney, replacing your gutters, paying somebody to clean your gutters. Parents and children come into your home. You can deduct just about everything in your home. In the playroom, everything in the playroom. What else outdoors? A fence, patio furniture, wheelbarrow, rake. Our parents and children in the living room. Curtains, shades, blinds, chair, lamp, ceiling fan, end table, rug, couch, screen in front of the fireplace. Everything in your bathroom. The garage. Tools, garbage can, paint cans, outdoor play equipment, cribs, a ladder. The basement, washer, dryer, tool bench, all the tools, a freezer, extra refrigerator, storage shelves, just about everything. Do children take a nap on your bed? If so, you could deduct your bed, the blanket, the sheets, the pillowcase, the rug on the floor to walk on to get to the bed. If children don't sleep on your bed, you can't deduct any of it. It's easier to think about what's not deductible. What's not deductible are things that are only used personally. Your hairspray, your nail polish, repairing your glasses, the books the novels that you read at night, your motorcycle, your clothing. The only time you could deduct anything about clothing is if you have a logo on there or the union name on your shirt. Daycare is great, something on your shirt or sweater, that's advertising. But even if you buy clothes that you're only using for childcare, it's not a deduction because it's not considered a uniform. Okay, let's just see if I can catch up here. If I use the grant money towards expenses for my business, you won't be able to deduct the expense and it would count towards income. No. If you use the grant money to $1,000, you pay yourself $1,000. But now you spend that $1,000 on something used only for your business. You can deduct the $1,000. If you took the original $1,000 and spent it on something for your business and didn't pay yourself, you can still deduct it. When you use the stabilization grant money for something for your business, you can always deduct either all of it or part of it. And whether you buy the stuff and not pay yourself, or pay yourself and then buy the stuff, doesn't matter. It's still always a deduction and it's always income. Would fixing the foundation of my house be allowable as an expense? That one, you can't use this for a major improvement. And fixing a foundation, I'm not sure. So therefore, pay yourself. And then you can use it to fix your foundation and deduct some of that cost. On a single member LLC, lost the question. Where did it go? Somebody deleted that question, so I can't find it anymore. Remodeling the bathroom to have it safer, more appealing to parents and children. How do I deduct it? Same answer I gave before about less than 2,500, more than 2,500. It's a little tricky. Contact me later. This video is being recorded. You'll be able to get access to the recording later, and you'll get a copy of the PowerPoint slides. Are all the common deductions you said, do you have to use the time space percent? Any expense that's both business and personal, you must apply the time space percent. You cannot claim 100% of it. All right, we're gonna move on. Bigger expenses: property tax, mortgage interest, rent, utilities, gas, electricity, water, sewer, cable TV, propane gas, wood, solar panels. My wife and I put solar panels on a roof a year and a half ago. If I was a family childcare provider, I'd be able to deduct part of the cost of the solar panels, house insurance, house repairs, depreciation on your house. This represents thousands and thousands of dollars. In most cases, these are shared expenses, unless you're doing childcare in a space that's used exclusively for business. In order to claim an expense, you need an adequate record. The best record is a receipt, but you're not required to have a receipt before you can claim an expense. It's the best kind of record. What if you don't have a receipt? You might have a canceled check or a credit or debit card statement. That's better than nothing. But you go to Walmart and spend $50, but lose the receipt. You have a monthly statement that'll say February 10th, Walmart, $50, but we won't know what you bought. Did you buy baby wipes or shotgun shells? We don't know. So therefore, you would want to write out a written record, a note on that monthly statement that says baby wipes, children's supplies, something, writing out on the monthly statement or in the memo line of the check is going to be considered an adequate record. If you're paying cash for something at a garage sale, yard sale, Craigslist, buy something from your neighbor, you need to write out a written record that would say June 10th, used high chair, paid cash, $10, garage sale. Then take pictures. If you've bought items so far this year that you don't have a receipt, go get a camera and take pictures of those things and write out a record of where you bought it, when you bought it, how much it cost. If you can't remember exactly, that's okay. Estimate it. Because with a photo and a written record of some sort, you're going to be okay. You can deduct all expenses associated with COVID. Are you spending money on gloves and masks, disinfectants, thermometers, sanitizers, room dividers, face shields? You're paying somebody to come in and do deep cleaning. You're paying for food deliveries or other deliveries because you don't want to go outside as much. And you tip the delivery person, that's deductible. You're spending more money on curriculum or activity expenses. You're doing distance learning and you're paying for an iPad for the kids. You're closed for a period of time. And during that time, you do some painting, construction, remodeling. One provider did not want parents to drop off and pick up her kids in her home. She had them do that in her garage. And she spent money to insulate her garage. She can deduct that. Another provider bought a ventilation system for the rooms the children were in. That's deductible. Save receipts for everything. What about larger expenses? The rules have changed in the last few years, and the rule now is this. With 3 exceptions, you can deduct the business portion of any item in 1 year, regardless of the cost. You put up a fence that costs $15,000, furniture, appliances, swing sets, a patio, a driveway. 1 year, you don't have to depreciate it. The 3 exceptions are the house, a home improvement, and a home addition. The house. You're doing childcare in your house, you always want to depreciate it. You must depreciate these things over 39 years. Don't let somebody tell you not to depreciate your home. It's worth a big deduction. Let's say you're entitled to deduct $1,000 a year in house depreciation. And let's say you're in business for 10 years, and then you go out of business, and later you sell your house. Whenever you sell your house, you're going to owe taxes on the amount of depreciation you claimed. So in my example, you'd owe tax on $10,000. But what if you didn't depreciate your home because somebody told you not to, or you didn't realize you should? You will still owe taxes on the amount of depreciation you were entitled to claim, and that's $10,000. So you're going to pay the same tax later when you sell your home, whether or not you depreciate it now. So if your tax person tells you not to depreciate your home for whatever reason, that's wrong, and you should find another tax preparer. A home improvement must be depreciated over 39 years. What is a home improvement? It's replacing more than half of your windows, more than half of your flooring or doors. It's replacing your furnace, remodeling your kitchen, adding a deck. 39 years. A repair can be deducted in 1 year, regardless of the cost. Replacing less than half of your windows, less than half of your doors, less than half of your flooring. Cleaning your furnace, repairing your furnace. Replacing just the countertops in your kitchen. Staining your deck. Those are all repairs that can be deducted in 1 year. All right, let me catch up with some expenses here, or questions. Question: if I started my business over 5 years ago, but just started using my living room this year for childcare, can I begin to depreciate the items in the living room if they were purchased last year? That is, new furniture used by the family and the daycare kids. So let me say a couple things here. Whenever your business began, you had a house full of things. You didn't buy them for your business, you just had them. Washer, dryer, freezer, refrigerator, beds, rugs, and so on. But now you're using all those things for your business. There's what's called a startup rule that allows you to claim part of the value of everything you owned before you went into business based on its value at the time you did start using it for your business. If you go to my website and search startup rule, there's a long article that's quite detailed on how to do this. So you bought some items last year that are now being used this year. In the year you start using something for your business, you can claim expenses for it. And for furniture and appliances, you do not have to depreciate them. That's been the change over the last number of years. Furniture, in your case, you can always deduct in 1 year, the business portion, whether you bought it before you start, you bought it a year before you started using your business. You would say, what is that furniture now worth at the time I started using it for my business? It's a guess. Multiply it by your time space percent, deduct it in 1 year. Or if it's put in a room that only the children are using, claim that entire business portion in 1 year. All right. I just bought a Surcut. I don't know what that is. Was planning on using it to make short sweaters. Can I partly deduct the cost of that? If you're using an item to make shorts or sweatshirts for the children, then yes, you can deduct part of the cost of the equipment and the materials. Yes. Question. I'm a sole proprietor since I opened in 1997. Now I hear that I should be an LLC, a limited liability company. What's the best? I have employees. I can't go into detail about the question of whether or not people should incorporate their business. You can go to my website and search limited liability company. My short answer is you shouldn't do it. Now you have employees, that's a little bit of a reason why you might, but there are a lot of drawbacks for being an LLC or a partnership or a corporation. Go to my website and read about it. I've written a book, Legal and Insurance Guide, that goes into this question in great detail. Or please give me a call. I'm happy to try to explain this in more detail. Do not become an LLC or a corporation until you've talked to a tax preparer and an attorney who can explain to you both the legal and tax implications of that decision. Yes. You can after you pay yourself. So if you pay yourself first, then you can use it for personal purposes, for emergencies, for emergency fund, for whatever you want. Okay? All right. Question. Won't the stabilization income hurt me when it comes to health insurance through Obamacare? It can. So that is potentially a problem because it's income. And that may kick you out of the eligibility for getting tax credits through Obamacare. I don't know exactly how that works with Obamacare. So you'll have to ask to find out. So I can't answer for your particular situation what will happen. I'm a single person LLC. How do I treat payments to myself relates to taxes? A single person LLC pays taxes in exactly the same way as a sole proprietor. You're filling out the same tax forms. You can't even tell by looking at your tax return that you are an LLC. So, how do you pay yourself as a single person LLC? The same 3 ways I talked about. Transfer the money, write yourself a check, make a note that this is money for yourself. Would a window for just a daycare room be acceptable? If you're just putting in one window, you could use the grant money for that. And if it's in a room just for daycare, you could deduct 100% of the cost of that. Can I use the money to buy a fence? I'm not sure if that's a major improvement or not. So I would just pay yourself first to be safe. Can you use the money for a refrigerator? Yes. Question, if I have put my money into savings, should I transfer it back to my business account? Then I'm on different days, transfer each month back to the savings account. It doesn't matter. It doesn't matter where the money ends up. It doesn't matter where you transfer it to. It doesn't even matter if you don't transfer it. So it doesn't matter. Question, I pay my husband from a personal check. At the end of the year, I give him a Form 1099. Can he do his taxes? Is this okay? Well, this opens up a can of worms. So if you're paying your husband to help you do childcare, you must treat him as an employee, not as an independent contractor. And you do not give him a 1099. If he's working, helping you care for children, you must be withholding Social Security, Medicare taxes. He must report that and pay federal and state income taxes. So you're not getting any benefit as a family by paying your husband. Think of some other way to reward him. So that's the short answer. What else? If you have somebody who's working in your home, whether you are paying them or not, you must be getting workers' compensation insurance for them. If you're paying your husband to work in your business, you must get workers' compensation insurance. If he's voluntarily working for you in your business, you still must get workers' compensation insurance. If you have your grandmother come over and help you with the kids, you must get workers' compensation for her. New York has very strict rules about who must purchase workers' compensation insurance. And family childcare providers have gotten into trouble in New York because they were not aware of these rules. So that's the best I can tell you. Be very careful if you're having somebody else in there helping you with children. Take a look at your responsibility as workers' compensation insurance. Question, I use credit cards for most of my purchases to earn points, okay? Can I use a grant money to pay those card balances? You can for the business expenses on your credit card going back to January. Only the business portion of the expenses on your credit card. Yes. I have a corporation. I use the money to pay myself. Here's how it works. Corporation gets $10,000. Corporation reports $10,000 as income. The corporation then pays you $10,000 through payroll. So you're not going to get the full $10,000 because they're going to be withholding of payroll taxes. The amount that the corporation is paying you, part of it in payroll taxes, part of it you getting as a salary, totaling $10,000, is a deduction to the corporation. So now the corporation is not paying any taxes on all of the money they gave to you. You must report as income the $9,500, whatever you got as income as an individual. And you'll have to pay income taxes on what you got through the corporation. What if the daycare is not used by the children? Then you can't deduct it. You can't deduct it. So have field trips to go out on the deck. What about changing the roof? If you're just replacing shingles, I don't think you can use the grant money for that. But you can pay yourself and then use it for that. I replaced the floor in a room used only for daycare. Can that be a repair since it's not more than half of the flooring in my house? Yes. You're replacing less than half of the flooring in the entire home. Therefore, you can deduct it in 1 year as a repair. Question, somebody is pointing out that in many retail stores, Walgreens, CVS, Kohl's, Marshall, Target, Home Depot, Lowe's, that you can get receipts electronically sent to your email. And you can get a report at the end of the year of all your expenses at those stores. That's an easy way to be able to save all your receipts. Yes, great idea. I bought a kitchen table at a yard sale. It cost $1,200. You don't get a receipt, you paid cash. What do? You write out a note. Where did you buy it? How much did it cost? Here's a picture of it, and you deduct it. If you're only using it for your business, deduct the full $1,200. Is this webinar mainly focused on self-employment? Yes, because the vast majority of family childcare providers are self-employed, and that's what I'm primarily directing this at. How will stabilization grant affect my Social Security? Well, that's an interesting question. If you use all of the money to buy business stuff, there's no change in your taxes, so it will have no effect on your Social Security benefit. If you take all the money or some of the money and pay yourself and don't use that money for business expenses, your taxes will be a little bit higher, including your Social Security taxes, and that could have a small increase in your Social Security benefit. If I'm on Social Security, if I'm on SSI, should I let them know about this grant money and will it affect me? I don't know. Should you notify them? Yes. Can I pay off my EIDL loan with the grant money? Not directly, but pay yourself first, and then yes, you can use that money to pay off the EIDL loan. Somebody bought something 2 years ago, a couch. Didn't claim it. Can you claim it now? No. You must claim it in the year you started using it in your business. You said 2 years ago, so I guess you'd have to go back and amend your return. Because you didn't claim a deduction in 1 year, doesn't mean you can claim it in the next year. All right, I'm going to move on. The time and space percentage. I've talked about that a little bit. How much of items can you deduct? As I've said, if you're using it exclusively for personal purposes, you can't deduct any of it. Your clothing, your motorcycle, your hairspray, no. Your gym membership, your yoga class, your meditation tapes, no. If you use something exclusively for your business, you can deduct all of it. If you're using something for both business and personal purposes, you can deduct part of it using what's called the time and space percentage. It's the formula that you can use to determine how much of your shared items you can deduct. And there are a lot of shared items. All those expenses associated with your house, including furniture, appliances, supplies, household items, pictures on the wall, everything. It's based on a time percent, meaning the number of hours you're using your home for your business, and a space percent, meaning the number of square feet you're using on a regular basis in your business. You're multiplying these 2% together to come up with a time space percentage. If you're doing childcare in your home, you must fill out IRS Form 8829, expenses for business use of your home. The time percent includes the hours children are present in your home from the moment the first child arrives until the last child leaves. And it also includes the hours children are not present in your home, but you're still doing some kind of business activity. The space percent is based on the number of square feet you're using on a regular basis in your business. Regular use means you're using the room 2 or 3 times a week for some business purpose. Children take a nap in a bedroom every other day for 20 minutes. That's regular use. Children don't have to be in a room for it to be considered regularly used. Children do not take a nap in your bed, but in your bedroom, you have a computer, a printer, a copier, a file cabinet, you're storing childcare stuff in your bedroom. That's regular use. You must include the basement and garage, if you have them, as part of the total square feet of the home. But for most providers, they'll be able to count those rooms as regularly used. In the basement, you might have a laundry room, the furnace, the water heater area, the tool bench area, the extra refrigerator, the freezer, the toys you're storing down there, other items you have down there that are used to maintain your home or used in your business. Your garage, you got the car, you've got wheelbarrow, you've got the snow blower, you've got the paint cans, regular use. Now, this year, COVID makes a big impact, I think, on your time space percentage. If you've been closed for part of the year, that lowers your time and space percent, lowers your deductions, and will increase your taxes. For some providers, they're working more hours this year because of COVID. That can increase their time space percentage, increase their deductions, and lower their taxes. Now, before COVID, you were always entitled to claim hours you were spending in your home when kids were not there, doing a business activity, cleaning, record keeping, activity preparation, meal preparation, and so on. If you were working fewer hours this year because you were closed for part of the time, or you're caring for more children part-time and don't have as many hours caring for children, you want to pay close attention to tracking all these hours, particularly related to COVID, that you're doing work when kids are not there. Cleaning. Are you cleaning more because of COVID? Distance learning with children. Talking to parents and children on the phone. Talking to licensors on the phone. On hold at the unemployment office. Activity preparation. Record keeping. Zoom meetings. Time on the internet. Time on Facebook. Reading books when kids are not there, having to do with childcare. Taking a CDA class. Taking any other childcare related classes. Listening to me now. If you're in your own home now and daycare children are not present, when we're done, you need to take out a calendar and write down 2 hours, Tom Copeland tax Zoom meeting. These hours count. Have you tracked all the hours so far this year when kids were not present? I've always recommended that people track these kind of hours for at least 2 months each year. and to use the average for those 2 months for the rest of the year. Have you done 2 months of tracking so far this year? If not, I would go back and try to reconstruct these hours. Or start tracking the hours now for the next 8 weeks, even though that's going to spill over into next year. Then use the average for the next 8 weeks for all of 2021. In 2022, you want to always do another 2 months of careful tracking. Each year, do 2 months and use the average of those 2 months for the rest of the year. Tracking the hours when children are not present is the single most important thing you can do to reduce your taxes. Let me catch up here. If my daycare permanently closes in 2022 due to lack of enrollment, will the state ask for some of the grant money back? I don't know. I don't know. So you'll have to ask them. Somebody was approved for enhanced school tax relief. Will the stabilization grant affect that? I don't know. All these different programs and things that are unique to New York, I'm sorry, I don't know. Question, will you have to differentiate on your taxes what you use the grant money for, or will all the deductions go together? All the deductions will go together when you're claiming them on your tax return. If you're using some of the grant money directly for items that you're deducting, then you should keep a record to make sure you know what you bought with the grant money. So I would mark on the receipt, stabilization expense, so that if you're asked in an audit to show how you spent the money with the grant, you can show them the receipts that were specifically used with grant money. Can I use the grant money to purchase workers' compensation insurance? Yes, for employees, but not directly for yourself. Well, forget about yourself. Yes, you're hiring somebody or you have a volunteer, you can only use workers' compensation money directly with the grant for employees. You cannot use the grant money directly for volunteers or independent contractors. But if you pay yourself, then you can use that money to help pay workers' compensation for volunteers. Question, what about some parents who pay cash? Do I have to put that as income? Yes. Yes, parents pay you in cash. Any money you get, you have to report as income. If I go back and pay for previous supplies for daycare on my credit card this year, are they still a write-off even with grant money? Yes. Any of the grant money that you use for a business expense can be deducted. Yes. Buying a refrigerator. Yes, you can use the grant money for that. What is the maximum you can claim if you use your house as daycare? If you're asking what's the maximum time space percentage, there is no maximum. And I've helped 2 providers who were audited, were caring for children 24 hours a day, 7 days a week. Their time space percentage was 98%. And they could show the records that the children were there. And so we won. There's no upper limit for the time space percent. It's whatever it is for you. Question, I have a pool house separate from my home. I have it set up in the summer on hot days for games and in winter to store playground equipment. Can I use this space for time space percentage? Yes, a separate structure that's permanently attached to the land, and that's what it sounds like you have, should be included as part of the total square feet of the home. And as you describe it, you can count it as regular use. I received my license to operate in September and opened in October. Will I be able to claim any of these items purchased as when you're going through the application process? Yes, any expense that you bought to get licensed, buying toys, taking training, buying a first aid kit, whatever, that you're buying in preparation for opening up, you can deduct in the year that you open. So you opened in October, you bought stuff before October, you can deduct all of that this year on your tax return. Okay, I'm gonna move on. Car expenses. You can claim a trip that's primarily for your business. You can count a trip as a business trip if the trip is primarily for your business. More than half of the reason you're taking the trip has to be for business. So going to the bank to deposit money, going to the library to get children's books, going to a grocery store and spending more money on business than personal food, that's a business trip. You need to have an adequate record to show that you had a business trip. And you have a lot, a receipt. Maybe you have a mileage log, a canceled check, or a debit or credit card statement says you were there, a written record that I've talked about. You make a notation on your calendar. You write down park, school, library. That's the written record. That's adequate. A photograph. Here you are in the park in June. The photograph is proof that you were in the park. You do not need to record odometer readings. You just need to know how far each trip is. And you can use a mileage app to help you keep track of all this. In claiming car expenses, you can use a standard mileage method. For this year, it's 56 cents a mile. It's probably going to go up a lot next year. If you use this method, you can also deduct parking, tolls, toll bridges, the business portion of car loan interest, and vehicle property tax and excise tax when you're paying for the sticker on your license plate. That's all you can claim using this method. If you use the actual vehicle method, you can deduct the business portion of gas, oil, repairs, car insurance, parking, tolls, depreciation on the car loan interest, ice scrapers, jumper cables, new tires, everything. The business portion is based on the number of business miles you drove divided by the total number of miles you drove. So if you drove 2,000 business miles and 10,000 total miles, you could deduct 20% of all the actual expenses. Most providers use the standard mileage method because it's a lot simpler. You don't have to save receipts. The food program. You're always financially better off by being on the food program. Reimbursements from the food program are taxable income, with the exception that if you're getting reimbursements for your own children, that money is not taxable income. Any food that your children eat is never a deduction. Any food that you eat at home is not a deduction. The most common way to claim food expenses is to use the standard meal allowance method. Using this method, you do not need to save any food receipts. You add up your meals and snacks and multiply them by these rates. And for 2021, it's $1.39 for breakfast, $2.61 for lunch and supper, 78 cents for a snack. All providers who work out of their home can use these numbers, whether or not you're on the food program. You can deduct up to 1 breakfast, 1 lunch, 1 supper, and 3 snacks per day per child if you serve that many. Meals and snacks that you serve that are not reimbursed by the food program do not have to be nutritious. So you're on the food program and are serving breakfast, morning snack, and a lunch. You can get reimbursed for those 3 servings, but no more. Now you serve an afternoon snack. What are you serving? A popsicle, cupcake, candy bar, Doritos. That's a snack. I'm not telling you to serve junk food. I'm telling you that whatever you serve is a snack. So in the afternoon, you're saying to the kids, who wants a popsicle? It's time to have a popsicle. And one child says, I don't want the popsicle. You say, you're going to have the popsicle because I can deduct 78 cents for this thing. One provider said, as the children left at the end of the day and were walking out the door, she passed out a cracker. 78 cents, 78 cents, 78 cents, 78 cents. She's making money passing out crackers. 1 snack a year for 1 child each day is a $202 deduction. You need to have a daily record to show all these unreimbursed snacks. If you haven't been tracking it, you need to go back and reconstruct it for this year. You don't need a menu. You don't need a recipe. You don't need a receipt. You don't need to say what the snack was. You just say snack, or just S means snack. That's it. A few providers will use the actual food cost method. And because of the higher food prices now, and because you might live in a place in New York that has high cost of living, you might be better off using this method, meaning you can deduct the actual cost of the food served to the children. But to use this method, you must have receipts, food receipts for yourself, as well as food receipts for the business kids. And that's a lot of work. Now I want to say something about Social Security. Sorry. Let me catch up on a couple questions. I've never used my living room as part of the time space percent, but children must walk through our living room to get to the bathroom. Can I use a living room in our time space percent? If you're just walking through a room, that's not regular use of the room. I would say no. So have a field trip into the living room twice a week. Then you could count it as regular use. Ah, she says, I also let children nap in this room. So are they napping 2 or 3 times a week? Are there stuff stored in the living room that you're using? You know, I mean, you could call me and we could talk about this some more. Question. How did I win an audit with a person using 24 hours a day, 7 days a week? Because a provider showed her records that said when every child arrived and left. And she had a child there every minute of every day. So as long as you have the records to show your hours and records, you know, in your space, taking pictures if you need to. I've written about this audit on my website, and it went to tax court, and we won. So if you want to know more details, look at my website or give me a call. Question, I have 4 rooms in my home that are totally used 100% for business. And I didn't talk about this. If you have a room that's used exclusively for your business, then you're doing a different calculation to determine your time and space percentage. Having an exclusive use room means you never, ever, ever use it personally. And a lot of providers have such rooms. If you have such a room, it will significantly increase your time and space percentage. If you go to my website and enter exclusive use rule, you'll see examples of how this is calculated. My record-keeping book describes this in great detail. The 2022 rates are out for what you're going to get reimbursed for 2022. But the numbers I gave you are what you can deduct for food expenses in 2021. Question, are my pet vaccines required by the state deductible? If we're talking about a dog or a cat, the only time you could deduct these vaccines is if you were not required to have a vaccine if you weren't licensed. In other words, you're only required to get a vaccine because you're licensed, then you can deduct it. But if you weren't a childcare provider and you still were required to vaccinate the pets, then no. All right, I got to move on, and I'll come back to the questions. Social Security. Why do I talk about this? Many providers are hurting financially and might be thinking about claiming Social Security earlier than they planned because they need the money now. So it's important to understand a little bit about how Social Security works. You can start claiming Social Security benefits as early as age 62. Your full retirement age is either age 66 or 67, depending on when you were born. If you claim Social Security before your full retirement age and still are working and are earning more than $18,960 profit this year, your Social Security benefit is going to be a little bit lower. Now, once you reach your full retirement age, Social Security will start paying you back some of that money that you lost, but it'll take a number of years before you get it back. Once you reach your full retirement age, you can earn as much money as you want, and it will not reduce your Social Security benefit once you start claiming. When should you claim Social Security benefits? For each year that you wait after age 62, your benefit's going to go up a little bit each year. And between your full retirement age and age 70, which is the last year you can get Social Security, your benefit's going to go up by about 8% a year. So there's a financial reward for waiting, and then a much bigger reward for waiting those last few years. So in most situations, the longer you can wait, ideally until age 70, is best. Now, you may not be able to wait that long. Your health is bad, you need the money now, you have other financial issues. Okay, but you should understand the consequence of claiming Social Security earlier than age 70. Before you make the decision to claim Social Security benefits, I strongly recommend you take these 2 steps. One of the single most important financial decision that you can make is when to claim Social Security. So, first, you want to go to the Social Security website, socialsecurity.gov. And if you haven't already created your own account, do so. Then you'll see your annual Social Security statement. It will tell you how much you will receive at age 62, your full retirement age, and age 70. So you can see how much it's going to go up the longer you wait. It assumes that the amount of money, your profit from last year, will be the same each year until you reach age 62, your full retirement age, and age 70. Your statement will also show you how much you earned each year of your life. And your Social Security benefit is based on the highest 35 years of earnings over your lifetime. Next, you want to go to this online Social Security calculator called OpenSocialSecurity.com. It will tell you the best time to claim Social Security benefits to get the maximum benefit over the course of your life. So you'll put in your age, how much Social Security says you will get at your full retirement age. If you're married, you put in your spouse's information, and it'll tell you the month and the year each of you should start claiming Social Security. It makes a difference if you're divorced, how long you were married to your previous spouse, are you a widow, are you disabled? There's other circumstances here. Social Security is complicated, but what I'm telling you is you don't want to make your decision until you've looked at this calculator. You can take that information and talk to Social Security to make sure it's correct, or take it and talk to a financial planner, but this is an invaluable tool. All right, a couple last comments, and then I'll pick up the rest of the questions. SBA forgivable loans. It's the Paycheck Protection Program expired many months ago. So now people are applying for forgiveness. You apply for forgiveness through your original lender. I've written about the details of how to fill out the forgiveness form and which form you should use on my website, which includes a short video explaining this. So If you need more help with the forgiveness, contact me. The EIDL loan is still available. It's a loan that you'll have to pay back over 30 years at 3.75% interest. You can use it for just about any business expense, including paying yourself. Now, since you're getting a lot of money for the stabilization grant, you probably don't need the loan. But maybe you're spending a lot of money putting an addition on your home, or if you're a child care center, you're expanding, you got a large expense that the stabilization grant won't cover, then you could consider getting the loan. All right. In summary, you want to report all these grants as income. You want to claim all the business expenses you're entitled to claim. You want to carefully track the hours you're doing business activities in your home when children are not present. I cannot overemphasize how important that is. And before you start claiming Social Security benefits, educate yourself about the consequence. Here is my contact information again. And now I'm going to try to answer some more questions. So let's see what we got. So somebody says, I should mention that all these items that you can deduct are great, but it will reduce your taxable income, which could reduce your Social Security benefit. All right, that is true. So as a family child care provider, as I've explained, you are entitled to claim hundreds and hundreds of expenses. And for some providers, that means every year their profit is relatively low, and therefore they're not paying a lot in taxes. But since your Social Security benefit is based on your profit, that could, well, it will have an effect of lowering your Social Security benefit. That is true. My advice, take some of the money that you've been saving on your taxes to open up and contribute to your own IRA. I do not recommend not claiming some expenses to make your profit a little higher in the hopes that you'll get a higher benefit. You can use the Social Security website and manipulate your numbers by putting, there's a calculator on there called an estimator. So you could say, well, I'm going to take Social Security 10 or 15 years from now. What if I reduce my, increase my profit by $2,000 a year? How much will that impact my Social Security benefit? You can see that and see whether it would make a difference or not. But I don't think it's going to make a difference. So you need to take on investing for your own retirement through an individual retirement account. Somebody's asking a deck. They bought a pool, and then fire inspector said he wanted a deck. And can I claim the deck? If you're using the pool for your business and using the deck for your business, then you can deduct part of the cost of the pool and the deck. Can you deduct garage space if you use it for storage and outside play space? In the past, I only deducted the home space. The IRS rule clearly says you must include the garage as part of the total square feet of your home. Since you're using it for storage and play stuff, that's regular use. So if you had a room in your home in the past that was not regularly used, Adding the space of the garage that's regularly used will increase your time and space percent. Don't worry that you didn't count the garage in previous years. It doesn't matter if your time space is going along, and then suddenly goes up, or that the total space of your home goes up. Don't worry about that. That's not a problem. All right. Can you count the yard as part of the square feet of your home? No. You can only count the home, other structures, garage that's separated from the house. What would somebody say? A pool room, a pool deck, or a pool house, a barn, but not the yard, not the patio, not the driveway, because they're not part of the structure of the home, and they're not a separate structure. All right. How about Christmas toys for the kids? Well, listen to how I'm going to say this. If you give a gift, a Christmas present to a child that's wrapped, and they take it home and they never bring it back, it was only used by that child, and that's a gift. And you can only deduct up to $25 a year per child for gifts. But if you give your child, your daycare kids, a Christmas present, and they open it up in your home, and the other kids are interacting with it, it's an activity expense. You read the book out loud. They play the game. They do the puzzle. Then the child takes it home and never brings it back. That was an activity expense, not subject to the $25 rule. So a gift card to a child that doesn't bring that back, a gift, $25. Time to teach your children about sharing. Everybody's got to open up their presents now, or bring back the present if you opened it up at home, so all the other kids can see it and play with it. Are sheds considered structures? If a shed is permanently attached to the land, it's a structure. It should be counted as part of the total square feet of the home. Believe it or not, I've written an article on my website entitled, "Is My Shed Deductible?" I'd urge you to read that. What if the yard is divided in two and one side only is used for daycare? The space, you can't count space that's outside. Can you count the items in your backyard? The swing set, the mulch, etc.? Yes, but not the space. If my insurance said I need a fence for the playground, can I use the cost of the fence 100%? Good question. If your insurance agent says you must have a fence, or licensing says you must have a fence, then yes, I would deduct 100% of the cost, because you're only being required to do that because you're in business. Question, does the 25 gift rule also apply to employees? Yes, it also applies to parents. 25 to the mother, 25 to the father. Question, can I take an employee out for dinner to celebrate Christmas and spend more than 25 and treat it as a business dinner? There's a rule about a business meal. And on my website, there's, believe it or not, a long explanation of this. How do you deduct a business meal? Well, for employees, you can deduct half of the cost of the meal. Regardless of what it is, half of the cost you can deduct. Okay, see if I missed something here. Okay. Okay. Do I have to claim the time space percentage for a new septic tank and leach field I had to have replaced and a hot water system unit, or is it 100% deductible because I need these things to run my daycare? My daycare has their own bathroom separate from my home bathroom and their own heating system in their area. The daycare has a monitor heater and my home has a furnace, but the furnace did not need to be replaced. These are my biggest expenses. Well, it can get a little bit complicated here. So let me just say, you're using the new septic and leach field for business and personal. So the short answer would be apply your time space percent, but still deduct it in 1 year. Hot water system, time space percentage, deduct it in 1 year, unless the hot water system is only used in that daycare room. So again, if it's used business and personal, you can't deduct 100% of it. All right, we're out of time. Just see if I missed something else. I think I mostly answered just about everything. Can you deduct security cameras and services? Yes. Okay, I think I want to stop there. So again, you have more questions, send me an email, give me a call. I appreciate to listen. I hope it's helpful. You work very hard. I appreciate that. So I am done.
Thank you, Tom.
Thank you, Tom.
You're welcome.
Have a
Yeah.
great night, everybody.
Good night.
Good night, everybody.